This is a very important section where we are going to examine how banks create money. So we are going to split it into four sections. We will look at the different types of financial institutions that exist in Canada. We'll move on to look at how banks create money. How does a bank balance sheet look like? We'll talk about that. And finally, we will talk about the desired reserve ratio. In other words, the reserve ratio, what it's all about. Now, what are the types of financial institutions in Canada? We have a first, second, and third category. You have what is known as depository institutions. Then you have contractual saving institutions. Then you have investment intermediaries. So each of the institutions, they are just unique on the basis of where they obtain their funds and how they use it. So in order to distinguish them, you always have to ask yourself where their funds come from and how they use the funds they've obtained. So that's the main distinction. So here, for example, we are looking at the share of the different institutions. For example, if you take a look, you'll find that the deposit-taking institution constitute roughly 78%, the life insurance companies about 17%, property and casualty companies about 1.4%, and finally, federally regulated private pension plans about 2.6% of the financial institutions. Now, the biggest players in Canada are simply the 6 large chartered banks. So when you think of the chartered banks, when you think of chartered banks, you are thinking of banks like the Bank of Montreal, the Bank of Nova Scotia, you have CIBC, you have National Bank of Canada, and finally you have RBC, as well as, finally you have the TD Bank. So you have the 6 banks, they are known as chartered banks. Those are the 6 largest. Of course, you have smaller ones. Now, banks generally offer a large number of financial functions. For example, they serve as a means whereby the monthly bills of individuals are paid. So you can allow people to automatically withdraw money from your account, as well as you can receive your salary in your account. So they serve that function. They also provide financial planning services. So if you want financial planning, you can go to your bank and they will book an appointment and give you the planning you need. You can also rent a safe deposit at most of the banks. However, the most important function is that they accept demand and saving deposits. So you can have your demand and saving deposits. We had already talked about this in the previous video. And using the deposits, they are able to create money by making loans. We'll see what it means by creating money by making loans. That will be an important section of this video. So when banks lend to a person, it does not typically give the borrower cash. So if you go for a loan, the bank will not necessarily give you cash in hand. You will not leave with some coins and banknotes. Rather, it's going to either give you funds by a check, or it will simply add the funds into your checking account. So it's simply going to credit your checking account, and if you take a look online, you'll find that it has credited money into your account. And how do they make their profit? It's generally by collecting higher interest. So for example, if someone deposits money into their savings account, maybe the interest they will get for their money is maybe, let's say, 4%. And when the bank decides to give out loans, it's maybe going to give out loan at a rate that is much higher than that in order to make a profit. Now, let's start looking at how banks create money. So banks generally make profit by making loans. Now, they want to make as many loans as possible in order to maximize their profit. However, they must also have adequate cash reserves to meet the demand needs of customers. So for example, if a customer comes and wants their money that is in their demand deposit, the bank should have a certain amount. So when the bank gives out loans, generally when you keep your money, they will give out a certain percentage as loan, and they will retain another percentage so that if you come, they have some money. Now their hope is that everyone will not come at the same time. So here, for example, we are seeing the inability to provide requested funds could cause a run on the bank. Now a bank run occurs when everyone comes to demand their deposits. However, the problem is that they've given that out as loan, and that will cause a serious problem. When we move on, you will further understand why that is a big problem, and no bank is able to pay back all the deposits at once. That's why at times when you need a certain amount of money, they tell you to warn them in advance so that they can make sure that they have enough funds to be able to meet your needs. Now let's talk about the fractional reserve system. This is simply a system in which banks hold reserves equal to some fraction of their demand deposits. So you put money in your checking account and the bank decides to hold just a fraction of that amount of money, with the hope that the people who come to withdraw money will not be more than that fraction. So most money narrowly defined is in the form of demand deposits. So when a bank lends to a person, it typically deposits the money in that person's account. So when a bank gives you a loan, it will simply credit your account, and that constitutes a new deposit, hence money is created. We will take a look at a diagram to really help us understand that. So we will come back to that topic of banks creating money. Now let's get into balance sheet. A balance sheet is simply a financial record that indicates the balance between a bank's assets and its liabilities plus the capital of the bank. So in other words, if you deduct we'll take a look at the equation at a typical balance sheet, and that will help. So we'll just come back into this concept when we take a look at this balance sheet. So here on your left, you have the assets. On your right, you have the liabilities. And among the liabilities, you have the capital. So here, for example, you can see that under the assets, we are looking at the cash reserve that the bank has, which is generally a fraction of the demand deposits. So you have the cash reserve, you have the loans that the bank has given out, you have the bonds that the bank possesses, and you have, of course, the buildings of the bank. That, when you sum all of it, it gives you the total assets. On the other hand, you have what people deposited, you have the savings account, this is still deposits. When you sum all of it, you have the total liability. In other words, people can come and claim this money. The bank hopes they will not come and claim it, because if they claim it, so how are they going to solve that problem, given that they've given out loans of 7,200,000, and this is the cash they have. You have the cash reserve here. However, you'll see that we have a total liability, and this is the capital. So this is their capital. In other words, if you deduct the assets, if you deduct the liability from the assets, it's going to give you the capital. Now, assets are simply things of value that the bank owns. In this case, you have cash reserve, bonds, buildings, and also you have contractual obligations, the loans that the bank owns. So these are the assets of the bank. And of course, among the assets, the loans are the largest assets. This is where they make all their profit. Now, it's important for them to have good loans and not loans which are really bad loans they will never recoup. Now, when we talk of liabilities, we are looking at the financial obligations that the bank has to other people. This is what people came and dropped. So the main liability of virtually all banks is deposits. People deposit their money. That's the main liability of banks. Now you also have the capital, which is the difference between the bank's assets and its liabilities. Okay, here we want to talk about the desired reserve ratio. So the desired reserve ratio is simply the percentage of deposits that a bank chooses to hold as cash reserve. Why will they decide to do that? So that when people come for their money, well, you expect that a lower percentage will be demanded by the people who deposited that money. So the bank wants to keep cash on hand equal to a particular percentage of its deposits. So in Canada, for example, the current situation is that it's less than 5% of the deposits. So all the deposits, a bank generally keeps less than 5%. Now, any excess reserve, so if a bank keeps more than 5%, it means it is giving up the opportunity to make profit by giving it out as loan. So excess reserve, cash reserve that is in excess. So what we call excess reserve is just the cash reserve that is in excess of the desired reserve. Okay? Now, banks will convert non-interest earning reserves into interest earning reserves. So there's no reason for a bank to be keeping money that is not giving them any interest. It's going to convert it into interest earning reserves, sometimes into bonds, but most of the time it will want it to become loans. Now, we will come back to the concept of money creation through demand deposits. We will use a nice diagram to really go into it. So for now, I'll just skip this part because we are going to get into it here. So look at the whole concept of the fractional reserve banking system as well as the demand deposit. Now, the bank creates money in what sense? If you deposit a certain amount of money, let's say you deposit 100,000, what happens is that the bank will keep, let's say the desired reserve is 10%. It means it's going to keep 10,000 and you will have excess reserve as 90,000. So it's going to convert the 90,000 into loans. It's going to give it out as loan. So let's say person A comes and deposit 100,000. The bank will keep 10,000 and will give out a loan to person B as 90,000. Now person B will now take that amount of money and then drop it as demand deposit, either in the same bank or in another bank. Now when they deposit it in another bank, what happens is that that second bank will now keep 10% of the 90,000 and the remaining money, the 90% of 90,000, it's going to give it out as loan, and the cycle continues, and that is how money is being created. When we talk of the multiplier, we are going to clearly see how this cycle goes on, and just the 100,000 becomes multiplied into about 1 million. You find that a lot of money is created, money that is not real, it's created through this system. It just credits your account. You have money, but in reality, it's the cycle of fractional reserve system enabling banks to create money. Now, when banks create more money, they make the economy more liquid. In other words, people have money to do business, to do transaction, because when you drop the 100,000, you could have used the 100,000. That's just one person using it. But when you drop it at a bank, they keep 10%, they give out 90% as loan. That other, you can still use the 100,000 to do something, but that person will be able to use 90,000 for something else, and they will give 10% of the 90 to someone who will be able to use it to do something else, and the cycle goes on. We will talk more about it when we are taking a look at the multiplier. However, this system doesn't necessarily create wealth, because in reality we only have 100,000. It makes the economy more liquid and people can use money and do all sorts of things. So borrowers have more money, but they also have new liabilities. In other words, they have loans. Now, if you take a look at what happened in 2009, 2008, 2009, we want to talk about the concept of leverage at that period. So leverage is simply the use of borrowed money for the purpose of investing. So if you have $1,000, rather than just using the $1,000, you can take the $1,000 and then borrow maybe $99,000 and then use now 100 to invest. So leverage is using borrowed money to invest. Rather than just investing what you have, you borrow money and invest. So the leverage ratio is simply the ratio of bank capital total to assets. Now, this is regulated. A leverage ratio of a bank is regulated. It's regulated by the Office of the Superintendent of Financial Institution, OSFI. So they want to make sure, here we are saying a low leverage ratio indicates potential for bank failure. So we don't want the leverage ratio to be too low. We want it to be relatively high. So from the early 1960s until 1980, the average leverage ratio of major Canadian banks, we've already looked at the big 6 Canadian banks, decreased from around 5% to a low of 2.5. We want it to stay high, but it has gone to 2.5. And of course, the OSFI, which is the organization regulating it, they began imposing stricter controls and increased the minimum allowable ratio. I think it's about 3% if I'm not mistaken. So one reason why Canadian banks did not suffer a lot during the 2008 2009 financial crisis is because their leverage ratio was much higher than the banks in the USA. Right now it is 3%. And of course, you have what is known as the Basel Accord. You have Basel 1, 2, and you have a third one. It has adopted this ratio as a standard. Now, when you talk of the Basel Accords, Basel 1, 2, 3, these are just standards that banks are encouraged to use, and the EU actually forces them to respect the Basel Accords. Now, let's take a look at the next section.